Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. James O'Reilly, welcome to the Australian Finance Podcast.
Hey, good to be here. Thanks very much, mate.
It's great to have you here. We're going to be talking about something that is related to people that work in many different types of corporate roles where they might have some sort of benefit, long-term benefit of working with typically a really good employer. You're a financial advisor. You own and run Northeast Wealth here in Melbourne, but you service clients everywhere. You also host the super popular Australian Retirement Podcast with Drew Meredith. How have you found the podcast?
I love it. Yeah, I've just really enjoyed having the opportunity to talk about retirement with so many people, and we get some amazing feedback too. Some of it isn't so scintillating, but it's still nevertheless welcome. So yeah, I've really enjoyed it. Thank you.
Well, you guys are absolutely crushing it. For anyone that's not even necessarily at the retirement age, like the stereotypical retirement age, there is amazing content. Good discussions, Q&A every week, Thursday, and an extra episode drops every now and again as a bonus. We recently did, or I should say you, because you led this, did a statement of advice giveaway. And to put it in context for people that listen on the finance podcast rather than the retirement podcast, we had over 500 groups write in and spend a lot of time writing in and make the case for getting free financial advice from you and Drew, which is incredible, and it goes to show the community you've already built over there. So I'll put a link in the show notes for anyone that wants to tune into the Australian Retirement Podcast. Today we're going to be talking about RSUs, ESPPs. We're probably going to use a bunch of other acronyms, which I'll get you to define, mate.
Sure.
Not your first time on the Australian Finance Podcast, of course, but let's just dive straight in. So we're going to talk about RSUs. We're going to talk about ESPPs. Now, acronyms, finance, not fun. Let's break these down one by one. And as you go, can you define those acronyms, what they mean and who they're relevant to?
Yeah, thanks, mate. Yeah, and yeah, there is a little bit of confusion here. That's normal, but we are ready. We're going to do this. Let's start off with RSUs. So RSUs, that stands for Restricted Stock Unit. And practically what this means, this is when you will work for an employer and part of your package is that they are paying you not only your salary, which of course you get with almost any employer, hopefully, but also they're paying you in equity. They are paying you shares of the company at set intervals. And normally this works pretty well for both the employee and the employer. As the employee, your package is likely to be a lot higher if you're receiving additional remuneration in the form of company shares. But it's great for the employer too, because their cash flow isn't so drained because they don't have to remunerate you in pure cash, which of course, if you're in a growth company, you want to be holding onto that cash and reinvesting it
for sure,
as much as possible. And it also provides a real motivation for all employees that have RSUs to not only do everything they can to facilitate the growth of the company, because of course that means that my RSUs, my stock is going up in value, but also it helps to hold on to people, because when you're in a growth company, of course, you don't want really high turnover. You want people to really get stuck into their roles and develop expertise in their roles and then use that expertise to take the company and grow it in new areas. And so as part of that, RSUs, these restricted stock units, they can, in some respects, kind of give people golden handcuffs whereby you've got this great package, and if I was to leave to go to another company, I'd stop receiving a huge amount more salary that comes in the form of shares every quarter, for example.
So I know a lot of people, and I just wrote down here CBA, which stands for CommBank. A lot of people that listen to the show would be familiar with either themselves, their parents, or their grandparents who received shares because they worked for Commonwealth Bank or NAB or whoever, but CBA is often the most common. And they get these shares and then they say, I've got these shares, I made all this money, and it's awesome. And then you hear the stories of like founders and whatever. In our business, James, our early employees all have shares in Rask, even though that many of them have moved on, they still have some shares in Rask. But I'm led to believe in that, and we'll come to this in a second, but I'm led to believe that has tax consequences. So we can talk about that in a sec.
Oh, yeah.
I'm going to get you to define the ESPP. So you've just said restricted stock units is RSUs. Doesn't make sense for us to talk about ESPPs now and just define.
Yeah, let's do it. It'll only take a moment because really today is going to be much more about RSUs. But ESPPs, that typically employee share plan or share purchase plans. And the idea is that you might work for the CBA, for instance, and as part of working for the CBA, you have the option to buy shares, CBA shares specifically. And when I was at the CBA many years ago, that was an option that was available. And typically, as an employee, they would get offered to you at a discount. Now, you couldn't buy an unlimited amount of them. It was commensurate to your salary and a number of other limitations. But you might be able to say let's for simplicity say $5,000 of CBA shares every year, but you would get a 5% discount to market versus if you bought them through a broker, for example. So they're a different investment altogether. Really, what you're doing is saying, I like the trajectory of my company and I like, hopefully, the discount that I'm receiving because I work here. And so I'm using some of my own after-tax money in my own pocket to purchase shares in my company. Okay,
so that makes sense. So one is kind of you buy it, and then the other ones you may get it just as a part of your package.
Bingo.
Yeah. So that makes a lot of sense. I've heard a lot about this. So you've got the company that gets to pay the employee less in the meantime, but in effect they're saying, well, you take that kind of hit to your salary, but you're potentially, in addition to super and all those other things, you're going to get, if this works out, you hear people of like the life-changing amount of money. Maybe it's not always life-changing, but maybe it's like substantial.
Yeah, I've seen it be life-changing a number of times too. It can be.
We've got I said to you off air, we've got a couple of our investors actually who have had that. And it's wonderful for them, and I'm so happy for them. So let's talk about the scheme generally then. How would it work? Let's take it from the employee's perspective, principally. How would it work, an RSU versus just getting shares? Like, what's the difference? Let's talk us through all those machinations.
Well, the way that I like to look at an RSU arrangement, it's like imagine that you're sitting down with your boss on your first day of work, and they say to you, okay, well, great news, letting you know that out of your total package, whatever that amount is, let's say for simplicity, it's $200,000. I've taken the liberty of organizing that $50,000 a year is going to automatically be spent buying shares in our company for you. You're welcome. That's basically what it is. So these shares, they're going to, every quarter that we've agreed on how much you're going to get every quarter, and these shares they'll sit in the top drawer and they'll just keep rolling over, and you'll keep getting your 150, but the full 200, the other 50,000 is going to come in the form of shares in the company. So ordinarily, you wouldn't have a choice in that. You can't say, well, if it's all the same, I'd really love the cash. The whole point of the scheme is so that they don't need to use that cash for employees. And of course, as we talked about, there's other incentives for them to want to keep people motivated to stay. So at the very beginning of you working there, typically with your employment contract, it would also be outlined what your RSU entitlement is. And of course, you can use that to get a sense for, okay, well, what's my total remuneration package? Because it's no longer just what I'm earning in salary and super, it's also these RSUs that are coming through. And so once you know that, of course, you can have a sense for, well, how much practically am I going to receive overall, assuming the share price does nothing, firstly, which is a pretty safe assumption. And then, of course, if the share price does something enormous in the future, that can move on. But I'll add one more tiny thing, if I may, which is that I might take a moment to differentiate between two terms that are often used with RSUs. The first is called a tranche, and the second is called a parcel. Tranches of RSUs are like at the very beginning of your contract, where your employer says, okay, well, here is what we're going to give you in RSUs. And that initial promise might look like, for example, over the next 60 months, 5 years, we're going to give you X shares, and they'll come out every quarter. They will vest, which means they will become available to you on a quarterly basis. So that overall promise is called a tranche, a single tranche. But importantly, you can get multiple tranches. So you might be a year in and they say, hey, great job, you're crushing your role. We've got another tranche that's coming out to people who are in your level of seniority. And sometimes it can be a bit confusing, but you can end up with a scenario whereby I've got members right now that have 7, 8 tranches that are all running concurrently at the same time. So on a quarterly, at a quarterly date, the 15th of May, for example, they'll have 8 different parcels of shares that all get paid at the same time, all relating to different tranches. So that's a tranche, and then the parcel, of course, is the individual amount that comes to you every quarter.
Yeah, right. I gotcha. So there's something in the name, restricted stock units, right? What would be the difference if, say, I work for Northeast, so I'm like one of your really promising people, and you're like, hey, this could be an interesting thing. Maybe they want to be a partner in the business in the long term. Couldn't you just give them shares? Yeah. So what's the benefit of the restricted element?
The restriction is designed to encourage that the employees stay for longer. So let's imagine, for example, you came to Northeast and I thought, jeepers, this guy's unbelievable. And yes, I do want to give this person equity in the business. And we agree on an amount of $500,000, for example. Well, if that doesn't carry any restrictions, then overnight, the day that you start, you've got $500,000 of equity in the business.
Yeah.
And if
I can leave tomorrow
you decide to leave, well, I'm buying you out, or you've walked away with $500,000 of equity. So the purpose of a restricted stock unit, and indeed that I used the word vest before, this what we call a vesting schedule, is to say you've actually, the promise is that you'll get $500,000, but you're not going to get $500,000 overnight. You're going to get $500,000 over, let's say, a 5-year period. And so for simplicity, over a 5-year period, that's going to be 20 quarters, which means that every quarter you're going to have $25,000 of Northeast shares vest, which means that at the end of quarter 1, you have 25,000 of equity. And at the end of quarter 2, you have 50,000 of equity. And that continues until you've earned, by volition of staying, you've earned your full $500,000.
And that's where you said, like, after a year, you might be like, you know what, we said 500, that's cool, but I'm going to give you an extra 250. I want to do a 250. And that's the second tranche. That's like, now you're going to have 750 equivalent.
Bingo. That's exactly right. And especially as companies are growing quickly, this works well for growth companies. It doesn't work for companies that aren't growing, because I'm sure you can appreciate if you're not getting growth, then what's happening is you're just diluting the share price. So all the existing shareholders would be pretty upset if someone just arrived and got $500,000 of equity given to them and the value of the company wasn't growing commensurate to ensure that it still protects their investment.
Yeah, that makes a lot of sense. Okay, so I've heard, James, that the tax of these can be quite onerous, particularly here in Australia.
Yep.
I've heard of stories of a lot of people in the US, they go work in Silicon Valley or New York or wherever they go and work, and they get a lot of this equity over like 4 or 5 years, and they come back to Australia and they've already cashed it in. So they're quite happy and they've done that. And that's a really good environment for them to do that. But here in Australia, there seems to be extra layers of like tax administration, let's call it.
Yeah.
Can you give us the bird's eye view of that?
Yeah, absolutely. Let's go back a notch to talk about that scenario where you've sat down on your first day and your employer said, hey, great news. I've taken the liberty of taking 50,000 of your overall remuneration package and organizing for that to be invested in shares in the company every quarter, for example, and you'll get that every quarter. Again, you don't really have a choice here, which kind of sucks. Mm-hmm. But the byproducts of that, or the reason I encourage that approach, or when you're thinking about your RSUs, is that these shares are still part of your remuneration package and it is still treated as income.
Okay.
And so, yes, your employer has taken the liberty, or whoever has taken the liberty of taking 50,000 and having that invested every quarter. That is still income that was otherwise going to be paid for you and therefore paid to you. And therefore, in Australian tax law, that is taxable income in that year. And this can give rise to a really challenging tax environment depending on the performance of your RSUs.
Yeah.
Let's imagine hypothetically that we'll go back to the Northeast scenario and you've got your $25,000 that's vesting every quarter. Well, your income, for example, is going to go for the year from $150,000 to $250,000. Despite the fact that you don't have the cash for that extra $100,000.
So you're going to be paying tax on that extra 100.
You're going to be paying an extra $40,000 or thereabouts, 41 in tax that, and you don't have the money for it like you would have if you had been paid that full $250 in income. And frankly, this can get much more problematic in a wonderful way, I suppose, when the share price does astronomically well. Because if the value of Northeast shares triple over the period that you're investing, well, now every tranche at the very beginning, when they say, "Oh, here you're going to get $25,000 worth of stock every quarter," that's not $25,000 in dollar value, and we just work out what the share price is and give you that many shares. It's saying the share price is currently $1 per share, so therefore you get 25,000 shares every quarter. So if the share price has tripled in year 5, well, now the value of each vesting parcel that comes in that date is 75,000 AUD, not 25,000.
Yeah, which is great.
But you now have 75 times 4, $300,000 of taxable income that's getting added to your marginal tax rate and probably resulting in $125,000, $130,000 of tax.
And you've got the same income,
and yeah,
you might not be able to afford it.
There can be scenarios, and I've seen it before, whereby your tax exceeds your income earned for the year.
Yeah, I've heard of it.
Yeah, which is
time.
And now it's great, awesome, because it shows that, I mean, somewhere in the background you must have this huge bubbling value of shares that are growing. But I'm sure you can appreciate that practically creates a huge cash flow challenge.
Yeah, I've heard of that exact scenario where people have just thought, I don't know what to do. They just give it up. Like they get into a situation where they can't actually sell the shares right away to fulfill the obligation because they haven't got them yet. Uh-huh. And yet they've got the tax bill for them. And then in the meantime, they could so say, for example, you get to year 4 in your scenario, share price has gone through the roof. You're like, great, this would be a wonderful time to sell because I need the money to pay my tax bill.
Yeah.
And you're like, but I have to wait a year. So you try and figure it out. And then in year 5, the share price tanks. Meanwhile, you've just paid tax on it last year, but the share price is down. And it creates all types of challenges, right?
Yeah. Luckily, in most cases, with most RSUs you'll come across, once those shares vest, like for example, 25,000 in quarter 1 with the Northeast scenario, as soon as they vest, you can do as you please with them. So therefore, for most people that I encounter with RSUs, if you are at any point along the journey whereby you've got that tax bill, you should be able to sell those shares, save for perhaps having some redemption windows. Like some companies say you can't sell except for during there are blackout periods where you can't sell.
Which is what I see common in some of the mid-sized US companies.
Yeah. But I note that this your scenario can become extremely real for situations where the stock or the share, stock of course being an American term, but where the share is unlisted.
Yeah.
So where you've got Microsoft shares, yeah, that's right. With Northeast Wealth, imagine if it was 75,000 a quarter. So there's 300,000. You've got this walloping amount of Northeast Wealth shares. Who are you going to sell them to? It's not available on the open market. You come back to me and say, hey, can you buy some of my shares back because I need to pay the tax? And I say, look, Owen, either now's not a very good time, so I can't do it, or alternatively, yes, but I'd only buy them at a huge discount compared to what you and I both agree they're worth. These are some of the challenges you might face with an unlisted position. So always heavy emphasis on ideally having if you're with RSUs, having RSUs that are listed, because at least that way you've got the money available for the tax.
Yeah, fair enough. So when clients do come to you, you're mentioning that you have clients that work for some of those big tech companies, not just here in Australia, but abroad. How do you get over that cash flow? Is it understanding the RSUs if you can sell them on open market? Like, how do you deal with that?
Yeah, it's this is financial planning 101. With every one of our members that has RSUs, we are developing as quickly as possible a really clear understanding of what your tax liability is going to be that year. So as soon as the financial year ends, or in particular the last vesting schedule, which is typically the 15th of May for most companies, they tend to run on the 15th every quarter. So February, May, August, November. Varies, but that's the most common vesting schedule. And so after the 15th of May, when that final vesting amount has come through for the year, we can look at the total amount of vested shares that you've had for that year and work out what the specific value of that was, plug that into your income and say, right, when you do your tax return, you are going to, please expect, mental note, you're going to have to pay another $48,600, for example, compared to whatever your natural waterline of your tax was going to be had you not have had this. So as early as possible, we want to be setting the expectations for our members that here's where you're going to be when you do your tax in no later than May next year. And then, of course, the flow on of that is, well, where's that money going to come from? An obvious thing that we can do is ideally look to sell some of these shares in order to make that money available. That's not always an option. So how else are we going to facilitate this? Because the ATO is going to come knocking for that money, and when they do, we need to have the funds available.
Yeah, absolutely, you do. More like holistic. One of the things I want to talk to you about today is I do find that if someone is fortunate enough to work in one of these businesses or start one or whatever, the upside is that the share price does real well, and the value of that giving up that income is stupendously amazing. And that's how you hear all these stories of like founding employees and, you know, I was there on day one and they do all these types of things. How do you think about people having like 50, 60, 70, 100% of their wealth in the company that they work for?
Yeah, this is a real problem for a lot of people, because you should never have a huge amount of your wealth invested in just one company. That's just not good financial management. And hopefully you have great success with that company if you do have that risk, but that's a double-edged sword. You can have the good fortune of it doing well, and you can also have the fortune of it, or the poor fortune of it performing horribly and it really having a huge impact on your finances.
Yeah.
And if I can just expand on that momentarily to give you an example, some members a little while ago were invested in a US company. They were getting RSUs and big tranches of about $100,000 a quarter was coming through in every tranche, or every parcel, I beg your pardon. And the share price fell by 80%. And what happened was that the tax, like that had a $400,000 tax event for the year, 4 tranches or 4 parcels of $100,000, except the value of the shares, even though they could sell them, was only $250,000. So the tax that they were going to have to pay, forgive me my maths about it, but the value of them was like $90,000. So the tax that they were going to have to pay on the $400,000 of income that they'd received, that was around about $180K. But the value of the company right now, if I sold all my shares today, I've only got $90. So this, especially if you're an investment that absolutely tanks and falls in a horrible way, this can be a death trap. It can be awful. So I would always look at this on an individualized basis. It's a combination of, firstly, what assets do you have more broadly, and how much exposure do you have versus the other investments that you have. But then also, what are your goals? What are your plans? So, for example, we might be sitting with someone who says, in 3 or 4 years, I'd really love to, we're going to upgrade our home. We're going to use these RSUs. We're going to sell almost all of them. We're going to get a big whack with the tax, but we'll look after that. And then we're going to use all of this money to buy our dream home in Port Melbourne, wherever. Great plan. But what happens now if the share price starts to go in the opposite direction? Because that can single-handedly crush that dream. So that's where, in that scenario, we would be taking the view of probably looking to exit the position gradually, not leave the money in there all the way up until the day that we say, okay, it's time, and get a better level of diversification across your overall assets to make sure that, like, you've done very well from this. It's true that it could continue to do really well and you could have even more money. But fundamentally, if you can achieve your goal right now, or you're mighty close, then we should be looking to achieve that goal as safely as possible. And so having all of your money there is unwise. Yeah,
I've spoken to some folks recently that are in that situation where they've got very large amount of money if they're not the owner that were there early days, and they really just, I guess, need to just come back to that point about what's the goal. It's all well and good for this thing to keep going up, but what's the goal? Like, does it actually make sense for you? One of the things, James, is in the nitty-gritty of the tax position. So you say quarterly, but then there's like the yearly tax. Is that as simple as it goes, that figure goes straight into my income tax bill? Is that how you think about it? Is that the way it works?
There's, yes, initially, in the sense that when you receive those RSUs, as we discussed, that will be a taxable event. So for you to own them, you've still been paid income and then had that income automatically converted to shares. So you've still got to pay the tax on that income. It's not the only tax that can exist, though, because of course, once you own shares, well, they can either perform very well or very poorly. And of course, when they perform well, in particular, we're going to have capital gain. And when you sell shares that have made a capital gain, you will pay capital gains tax. So there's two types of tax that apply here. The first is income tax, which applies only to when you receive them the first time. And then the second type of tax is hopefully capital gains tax, which is that, for example, I received my my first parcel of shares, $25,000, way back in Q1 in 2025. But when that happened, I paid tax on that. But since then, it's tripled in value. So if I want to sell that particular parcel of shares, I've got a capital gain. It's worth $75,000 and I paid $25,000 for it. So therefore, I've got to manage a $50,000 capital gain. So that can get a little complex, of course, because we're talking about maybe you need to sell shares in order to pay the income tax. But ironically, selling the shares can create capital gains tax in order to look after the income tax. So again, that's where we'd look at this on an individual basis.
Yeah.
I would like to add, if I may, though, that like we were talking before about the vesting dates quarterly, and we were talking about the fact that you get this. You have this vesting schedule, and that would tell you what parcels of shares you're going to receive and when. So, for example, you're going to receive 25,000 in February the 15th, and then 25,000 in May the 15th, and it's going to continue going on. The important thing to be aware of is that there is a different tax event for every one of those parcels that you receive. And the reason that happens is because a share price moves all of the time. So let's imagine we get to a point in the future where the value of Northeast shares is $3 instead of $1 at the beginning, and so you've got $75,000 for your $25,000 you originally invested. So every parcel that you've received is now worth $75,000 because you received 25,000 shares along the way, which is great. Except the value of Northeast might have climbed up to $3 a share or higher for a little while, and then gone back down to $2, and then to $2.50, and then to $3 along the way. Yep. And what that means is that for that little period where the value of the shares was $4, if you were to sell those, you've actually made a loss on that particular parcel of shares. Now, there are other parcels you could have made big gains. And so this is something that we model really closely for our members, and we can speak to how we can help all the Rask community with this.
We should have mentioned this actually. So James, for everyone that's listening, has put together, of course, financial planner, put together a spreadsheet on all of this, and it will help you understand your tax position. So if you're watching or listening and you're thinking, okay, this is great, numbers podcast is hard, and I need to get on top of this, spreadsheet is for you. That will be available in your podcast player or in the YouTube description. We've got Navar Trosselou here from Navexa in the office today. I think you guys grabbed a coffee earlier on. And he's like tax reporting software and all of that. And he's constantly amazed that people don't understand the difference between different types of tax parcels and what system people are using, and how, and the amount of money people could save on tax by just recognizing what are the parcels, where do they come from, when were they acquired, when was they sold. People just think it's like one rule for everything.
Yeah, that's right. And it's definitely not that way. It surprises so many of our members when we sit down and they might say, I need to get out $30,000, for example, because I've got to pay for education expenses for my kids or whatever it would be, and I need to get that out, but geez, I'm getting hammered for tax. And we say, well, we could just sell these tranches. If we sold this parcel and this parcel, there's no tax. So we can release money from your RSUs right now with zero tax event if you want. I'm sure you can appreciate if we look at the overall portfolio that you have and we keep selling down low or zero tax positions, the overall tax liability within the portfolio is going to start to grow. Yep. But you can time that. You can manage that. Yeah, that's right. There's a huge amount of tax management that can go into RSUs that people completely miss.
Yeah, that's great. And I'd say also that may actually apply for people that are buying shares as well that have a complicated tax history. Study it. And if you don't know, use a tool, speak to an expert.
Agreed.
Okay, so coming to the back end here, there's some mistakes that you've got down here in the notes that I can see. I've obviously tried to bring a few of them to the surface, like different things around how much money, not managing different things. if you were to give us kind of a succinct list of things that people should be mindful of in this situation, what would they be?
Well, we talked before about tax liabilities. You've got to be prepared for them every year. And if you want to download the spreadsheet and use it, it's very easy to use, then that will really help you to know where you stand every year at least. But just knowing what your tax is for your RSUs at any given time helps enormously. The second one that I see all the time is overconfidence bias. People that have RSUs, of course, they're working in the company that for that particular share. And most people that I meet with, they speculate about their company and the likely performance of their company in a way that, with respect, they really don't have the grounds to do that. And as I've often said to my members, unless your role is C-suite, you're really privy to information which the market is not yet aware of because you're still working some things out, etc. Unless you're there, it's very likely that all of the information that you know about your company is completely understood by your Morgan Stanley investment analyst who's sitting with CFOs and the like in order to properly evaluate the performance of this company. And of course, institutional money really is what drives share prices more than mum and dad money. So it's great to have your own view around where the share price is going to go, but you really need to water it down. It's very easy to be too confident about where you think the company is going to go.
But also on that, if you do have a very strong conviction in it, I'm willing to bet you're not going to say, well, too bad, you got to sell it. It's like, well, you can have that conviction, but also why not do a little bit of diversification?
And let's compile independent research that substantiates that or says, well, actually, the view here is that even with that in mind, the company is still overvalued right now for these reasons. I think that can be really helpful.
Yeah, fair enough.
Underestimating the risks. I think maybe because RSUs, they feel a little free. Just to be clear, they're not. Again, they're your employer saying, hey, of your overall package, I've taken some of it and invested in shares for it. It's your money. But for some reason, I think a lot of people look at it as sort of this plus thing. Here's my package plus I get some shares. And the byproduct of that is they tend to be a bit careless about the risks. You have market risk because obviously it's a share and the share price is going to move. You have concentration risk. Most people with RSUs will end up with often an extremely disproportionate value of those shares compared to their overall financial situation. But another risk that people really miss often is currency risk, because you talked before about US, like Silicon Valley type, there's a lot of either US or European stocks that offer RSUs. It's much more common over there than it is domestically in Australia. And as a byproduct of that, you are staple to the performance of the US dollar, for example. If the US dollar tanks, go back to 2010 when the Australian dollar was $1.10 versus 2001 when the Australian dollar was 51 cents, like the value of your shares has more than halved just based on currency alone. So you are in a currency game if you have RSUs from an international company. Make no mistake of that.
Interesting. Okay.
But the last piece here for me clearly is the exit strategy. Hopefully, if you're listening to this and you have RSUs, hopefully you're having a bloody good time of it and it's doing exactly what you want it to do. And frankly, you should be, in the sense that we've seen a really pronounced, like, equity markets are close to all-time highs. There's a healthy level of consumer confidence at the moment, whether it's listed or unlisted positions. A lot of tech options that offer RSUs. Tech has gone crazy over the last 24 months. So if you are in RSUs that aren't performing well, that's a big red flag in this environment, right? But having said all of that, if you need to be really clear on what your exit strategy is. Like, what is this money ultimately going to go toward? How is it going to improve the quality of my life? What are the experiences and things it's going to facilitate? And if you know that really well, that allows you to be so much clearer on how to manage your RSUs, what you should leave invested, what you should take out and diversify, what you should use for your own personal goals.
I want everyone that's listening to this, if you don't own RSUs, to also have an understanding of them. And hopefully by listening to this, it's great that you've made it the whole way through. But secondly, think about where you are in your career. Think about the type of business that you want to work with. And yes, you can have the go and work at CBA or NAB down in Docklands and the beautiful thing overlooking Marvel Stadium. Great jobs.
It's not that beautiful.
I think it's quite nice. I had to do a prezzo in there, a financial wellness prezzo in this big hall inside, right next to the AFL ground. And it was just, I was like, wow, this thing is impressive. But maybe you're right.
You're the only Melbourneite that thinks the Docklands is beautiful.
Oh, the Docklands is not beautiful, but this building was special.
Okay, right, the building.
Anyway, I would strongly encourage everyone to understand this, particularly if you're in the first 20 years of your career. This, in my mind, James, this is kind of like, it's kind of, I don't want to use a finance term, but it's kind of like you have like this other thing that's kind of like super, but it could be
bubbling away,
working for you in a stupendously good way. And if you ever wonder why people who go to startups love the startup culture, yeah, it's harder, it's more of a grind, it's not a 9 to 5, it's all those uncertainty things, but the payoff can be significant. Yeah. And if you're negotiating with your employer, if you love the business, if you see yourself being there longer term, talk to them about what options you have with equity. I know a guy who actually had his own business and he employed 4 or 5 people, and he saw this other thing that was getting built in an adjacent industry, and he said, well, I'm kind of at a point now where someone else can just run this and it might not perform as well, but that is worth so much more to me to be on the ground level over there. And he went and did that. So he took a huge risk in going over there. Not only did he leave his company behind, he also remortgaged his house and invested in that company to the tune where he paid for 2 years of his salary to just work in this company and get some of the stock units as well as equity. And this is now 4 or 5 years later. It has been like, this is obviously like a very calculated, very informed person, but stupendous.
Wow.
And so there's other ways that you can make money through without taking the full amount of risk in your life. So go and check that out. If you already have RSUs, James has put together a spreadsheet. The link is in your show notes. It's there in your podcast player. Click on it, create a copy. It will help you make an informed decision. James, why would they get this spreadsheet?
Well, it's going to help you to understand really clearly the tax position for every parcel that you have within your RSUs. You only enter the data once. Once it's entered, then it's done. But also, it's going to give you much more clarity around all the financial decisions you have to make in the future.
Yep, great. James is available on LinkedIn. He's got the website, Northeast Wealth. There's a link in your podcast player that says financial planning. But if you want to speak to James directly, reach out to him. I'll put a link in the show notes to all of the things that we've mentioned today. James, mate, I know you've crossed the hallway. You've joined us here on the Australian Finance Podcast. It's great to have you back on the show, mate. And thanks again.
Yeah, thank you so much. A pleasure. And looking forward to next time, mate. Cheers.
Cheers. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.